Welcome back to the channel, Financial Explorers. Today, we're diving deep into a fascinating corner of the market, exploring a company that's showing up on our hard-to-borrow screener. We're going to dissect the mechanics of a potential short squeeze using a real-world example, shedding light on what it means when a stock becomes incredibly expensive to short. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Our focus today is 707 Cayman Holdings Limited, trading under the ticker JEM. This company operates in a consumer cyclical/apparel retail sector, selling and distributing fashion apparel products globally, from Hong Kong to North America, the Middle East, and Western Europe. Their product lines include denim, athleisure, sweaters, leather and outerwear, knitwear, and even pet apparel. JEM is a microcap with a market capitalization of just $2.02 million. Now, let's look at the recent price action. Chart JEM price history. JEM has seen significant volatility recently. Today alone, the stock is down a substantial 27.58%. Looking back, the last 5 trading days show an astonishing 69.90% decline, and over the last 30 days, it's done 20.33%. Highlight declines volume-wise. To date, we've seen 3,007,857 shares trade hands, which is actually well below its 30-day average volume of 8,310,528 shares, giving us a relative volume of only 0.4x average. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? In simple terms, it's the annualized fee that short sellers pay to borrow shares of a company to sell them, hoping to buy them back later at a low price. Think of it like renting a car. You pay a daily rate to use it. With stocks, this rental fee is typically expressed as an annualized percentage. When a stock's cost to borrow is very high, it's a strong signal. It means there's either very high demand from short sellers to borrow those shares, or, critically, there's an extremely limited supply of shares available to be borrowed in the market. This can push the annualized fee well over 100%, sometimes even into the thousands, because the market is essentially screaming that these shares are incredibly scarce. Why this stock is hard to borrow right now. And that brings us to why JEM 707 Cayman Holdings Limited is on our radar. The cost to borrow fee for JEM currently stands at an astounding 895.4% annualized. Highlight CTB number. Even more compelling is the momentum. This fee has shot up by a massive 795 percentage points over the last 5 trading days. This rapid increase suggests that the available shares for shorting have become extremely scarce, or the demand to short has skyrocketed, or both. Right now, there are only 95,000 shares currently available to borrow for JEM. Highlight borrow supply. While the exact estimated float for JEM is currently unknown, having only 95,000 shares available with such a high CTB is a significant data point. Our internal composite squeeze score, which combines factors like CTB level, CTB momentum, shrinking borrow supply, float size, volume/price momentum, and technical setup, gives JEM a score of 43.5 out of 100. Explained score is proprietary. It's important to remember that a high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to maintain their short positions. Squeeze mechanics explained. So, how does a short squeeze actually work? Imagine a situation where the price of a stock starts to rise, perhaps due to positive news or increased buying pressure. Short sellers who borrowed shares and sold them are now looking at mounting losses as the price goes up. To limit their losses or meet margin calls, they are forced to buy to cover, meaning they buy back the shares they originally borrowed to retain them. This sudden influx of buying demand from short sellers, all trying to cover their positions simultaneously, creates a powerful buying frenzy. If there's a limited supply of shares available, as suggested by JEM 95,000 borrowable shares, this forced buying can rapidly drive the price even higher, trapping more short sellers and creating a cascade effect. It's a feedback loop where covering drives price, which drives more covering. Dilution risk check. Before getting too excited about squeeze potential, we always run a dilution risk check. Dilution happens when a company issues new shares, increasing the total number of shares outstanding. This typically reduces the value of existing shares because the company's earnings and assets are now spread across more shares. For JEM, our check found no recent diluted SEC filings like SMINUS 1, SMINUS 3, or 424B over the last 90 days. This is a positive sign for any short squeeze thesis. Explain why dilution matters. Why does this matter? Because even with the sky-high cost to borrow, if a company decides to issue new shares, it essentially floods the market with fresh supply. This new supply can provide short sellers with easy shares to cover their positions, or simply depress the price by increasing the float, potentially neutralizing or even negating any squeeze potential. No recent dilution means one less hurdle for a potential squeeze. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For JEM 707 Cayman Holdings Limited, here's what to keep an eye on if you're tracking this situation. First, continue to monitor that cost to borrow rate. Will it stay elevated or even climb higher? Second, watch the number of shares available to borrow. A further reduction from the current 95,000 shares would indicate even tighter supply. Third, observe the volume and price action. Any significant increase in buying volume, especially on green candles, could signal a shift in sentiment. Given JEM recent sharp declines down nearly 70% in 5 days, a bounce could theoretically put pressure on shorts, but it's crucial to remember that a stock can always go lower. So, JEM 707 Cayman Holdings Limited presents an intriguing, albeit high-risk, educational case study in the world of hard-to-borrow stocks. With an annualized cost to borrow nearing 900% and a very limited supply of shares, it ticks some boxes for a compelling short squeeze scenario. However, the recent heavy selling pressure indicating strong bearish sentiment, and the stock's micro-cap nature mean extreme volatility and risk. As always, this analysis is purely for educational purposes. If you found this breakdown of 707 Cayman Holdings Limited insightful, please hit that like button, subscribe for more unique stock insights, and let us know your thoughts or other stocks you want us to cover in the comments below.